Let's broaden out the market conversation. We're seeing stocks extend their gains. The S&P 500 near a new all-time high after jobs added for the year ending March 2024 was revised lower by just over 800,000. It's the largest revision that we've seen since 2009, showing the labor market may have been a bit cooler than initially thought. Can the data continue to support the rally? We want to bring in Stephen Dover. He is the chief market strategist and head of Franklin Templeton Institute. It's great to have you here, Stephen. Let's talk about, I guess, just your first take on the revision to the downside that we're seeing 818,000 and what that implies or what that signals, if anything, here for the equity markets.
Yeah, I think it signals a soft landing. I think the revision is, within the range of what people thought. We were really quite white hot in the jobs report before. We're coming now down to a much more normal economy. We think that means interest rate cuts ahead, probably not as much as the market thinks, but very positive in general for the equity markets as we're seeing right now as the market goes up. In fact, yesterday was a little bit down, but we were looking, as you've reported, a streak of up market that we haven't seen, days up market that we haven't seen for 20 or 30 years. So the market is really taking this as an opportunity. I think what we'll see going forward, and the big shift we see going here, is a move from talk about inflation to talk about growth and increasingly talk about earnings.
I'm fascinated by what we're seeing in the market today, Stephen. So forgive me if I'm being a little bit too elementary here. I'm just curious. We got the data late. We saw stocks ripping. The S&P was just 0.5% away from all-time highs. We're seeing the gas come out of that just a little bit. The S&P and the NASDAQ pairing some of those gains, and the Dow is now under pressure. Is the market moving still off of that retail data? Is it moving off of an idea that the jobs numbers are going to get revised and be a better picture moving forward? What is the defining catalyst for why we are seeing these whipsawing moves in the market today?
It's hard to talk about today, but just in general, I think the market over the last 2 weeks has gone through a catharsis in which it really had an adjustment. It was overextended by leverage. And right now, the market's trying to sort itself out. I don't think this jobs report was particularly important to the market. I think what the market is seeing is we're having a soft landing. Interest rates look like they're going to drop. Earnings look like they're going to be solid at least. And that's good for the market. Let me give you just some data. We looked back at the last 50 years, actually, to 1972, every time interest rates have been cut, and divided those interest rate cuts into two parts. Cuts where we actually had an expanding economy, cuts where we actually had a recessionary economy. Now, in all cases, 1 year later, the stock market's up. But if we're headed into a recession, we get into some really rough times, as we all know, over the first 3 months. But it turns out okay. After a year, the market on average is up 5%. But if we're headed into an expansionary period, which is what we think is the case, once rates are cut, on average, over the last 50 years, the market's been up 17% a year later. I think that's what's driving the market.
So, Stephen, what does this all mean for investors? They're trying to figure out how they should be positioned, how defensive they should be, whether or not some of those cyclical plays still make sense within this environment, given the uncertainty. What are you telling clients?
We are telling clients, let's look back at what we've talked about really for such a long, long time, and that's a balanced portfolio. It makes lots of sense to be in fixed income. If we look at it over the last 2 years, fixed income did exactly what you hope fixed income did, and that's offset the volatility of an overall balanced portfolio. Within the equity markets, we're a little concerned about the equity markets getting ahead of themselves. But that said, we see positive results in the equity market over the course of the next year. Where do you focus? Strong quality companies, technology, industrials, healthcare, energy, and financials, utilities is where we see opportunities. Focus on free cash flow, return on invested capital. That's where we see opportunities. Within the fixed income market, we're a little bit concerned that the treasuries have gotten ahead of themselves. We've been arguing duration for a long time now, and it's just perhaps a little bit ahead of itself. So we're a little bit cautious on jumping in, certainly to treasuries right now.
Yeah, and it certainly looks like treasuries are moving to the upside a little bit off of that jobs data that we are still seeing. I guess the idea that the data is symbolic of a Goldilocks narrative for the economy and not too much softness.
That's where we are. And so what's the risk? Just like we saw 2 years ago. Nobody was reporting the carry 2 weeks ago. Nobody was reporting the carry trade 2 weeks ago. A couple of years ago, we had the same problem in the UK. The problem is somebody out there is over leveraged and you don't know what's going to happen at the market at any time. What does that mean for us? We're going to have continued volatility. But when you have these ruptures, which adjusts some of that over leverage, that actually makes the market safer for your typical investor. Another thing to look at, of course, is the dollar. We're seeing the dollar fall as other economies have dropped interest rates prior to the U.S. dropping it. So that is going to be interesting to look at for opportunities outside of the United States.